Something feels off with NIO. One month the market praises it as China's electric powerhouse, and the next it trades like investors have lost all confidence. The stock is hovering around $6, and that alone says a lot. When a company that once symbolized EV innovation gets stuck this low, something in the story has clearly changed. NIO sits around $6 a share, which says everything about where investor confidence stands. A few years ago, that number would have felt unthinkable for a company once called China's Tesla. Now it's the reality, and the next few weeks could decide whether this stock finally breaks out of its downtrend or sinks even deeper. Because on November 25th, NIO reports its third quarter earnings, and that date might define the rest of the year for this company. This isn't a routine update, it's a credibility test. Management has been telling investors that cost optimization and higher scale will show real improvement this quarter. But that claim is colliding head-on with tougher competition, tighter margins, and cautious institutional sentiment. Here's what we know. Deliveries look strong, around 87,000 vehicles in third quarter, near the top end of guidance. That shows demand is still there. But the issue isn't how many cars NIO sells, it's how much profit each car actually brings in. Price wars in China have turned every EV sale into a battle for survival. When BYD, Li Auto, or even Tesla adjusts pricing, NIO has to react. Every cut eats into margins, and even with more deliveries, profits can flatten fast. That's what's worrying big money. Analysts haven't turned bearish, but they've stopped being bullish. The consensus rating right now is hold, with price targets floating just slightly above the current level, around 630 to 650 on average. That's not enthusiasm, that's hesitation wrapped in politeness. And for a company like NIO, living on optimism is dangerous when the market's already running out of it. What's fueling that hesitation isn't just competition, it's the pattern. NIO keeps building, expanding, launching, and yet the stock never holds momentum. It's almost like the business and the chart are telling two different stories. Growth on one side, stagnation on the other. The latest capital raise of about $1 billion was supposed to strengthen the balance sheet, but it reminded everyone how dependent NIO still is on fresh funding. Growth costs money, and NIO is burning through a lot of it. The Anvo lineup, which was meant to inject energy into the story, became a mixed signal. The L60 launched smoothly, showing the sub-brand has legs. But the bigger L80, the model everyone expected to anchor 2025, got delayed to early 2026. Officially, it's a production scheduling move tied to heavy demand for the L90. But investors don't hear explanations, they hear delays. And when a company already fighting for momentum pushes a launch forward, it feeds the same question that's haunted NIO for years. Can it execute consistently? That's the heart of why November 25th matters so much. The company has to prove it's not just scaling, but stabilizing. Because the market has seen this story before. Delivery numbers rising, cash burn widening, promises about margins, then another reset. This quarter has to break that cycle. And this time, even small wins could make a big difference. If gross margins improve even by a few percentage points, or if management gives confident forward guidance, the narrative could shift. Because right now, everyone's waiting for a sign that the business model actually works. What makes this setup fascinating is how fragile sentiment has become. Not long ago, NIO's international expansion and battery swap network were the core of its excitement. But those ideas have matured. They're not catalysts anymore, they are expectations. Investors now want numbers, not vision statements. That's what separates hype from trust. And that's why this stock feels like a spring wound tide. The short interest is building, the analysts are neutral, and retail investors are watching that $6 level like it's a cliff edge. The moment earnings drop, it could swing either way. If NIO beats and shows clear signs of financial improvement, the recovery rally could be sharp. But if the report disappoints, even slightly, it could easily fall back into the low fives. The tension gets worse when you look at the broader EV scene. China's domestic demand is slowing, government incentives are tightening, and even big players like BYD are feeling pressure. That means competition isn't easing anytime soon. Every company is fighting for the same shrinking pool of consumers, and price cuts are their only weapon. For NIO, whose brand depends on a premium image, this kind of environment is brutal. You can't out-discount your rivals without eroding your brand, and yet you can't ignore pricing pressure either. That's a trap. And here's what makes it even more complicated. NIO's ambition still stretches globally. They want to expand to 20+ countries, push battery swap technology internationally, and keep premium branding intact. It's a bold vision, but the financial foundation to support it isn't stable yet. That's why investors are cautious, because they've seen this movie before. Vision without profitability always ends the same way: dilution, delays, and disappointment. But NIO's not finished. That's the part people overlook. Even after all this, the company's fundamentals aren't collapsing. Deliveries are holding up, its ecosystem is intact, and brand loyalty remains surprisingly strong. The pieces are there. What's missing is proof that the system can generate cash instead of consuming it. And that brings us back to the one number that matters most: margin. If NIO shows even a small rebound in margin this quarter, if it proves that cost discipline is kicking in, sentiment could flip fast. Because beneath all the skepticism, the market wants to believe again. Every analyst who rates it hold is basically saying, "Convince me." That's the power of moments like this. The stock's trapped in doubt, but doubt is volatile. It only takes one credible surprise to trigger a chain reaction. The question is whether NIO can deliver it. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. So, is NIO stock in trouble? Maybe not in the existential sense. It's not going bankrupt, it's not losing relevance, but it's definitely in a pressure zone. The stock's pinned down by hesitation, the brand's tested by delays, and the clock's ticking toward an earnings report that could change everything. If NIO meets expectations, it survives. If it beats, it rallies. But if it falls short, it could finally lose the one thing it's been living on for years: investor patience. This isn't about hype anymore, it's about proof. And in a market this unforgiving, proof is the only thing that matters. If you want to stay ahead of what happens when those results hit, make sure you're subscribed, because whatever happens after November 25th will tell us if NIO's comeback is real or if this stock has just run out of road.